Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, we talk with Dave Wright, co-founder and portfolio manager at Sierra Investment Management. For over 30 years, Dave and the team at Sierra have been managing tactical, global, multi-asset class portfolios, and they have a successful track record over multiple market cycles. Our conversation focuses on how these conservative portfolios are built, the importance of stop losses, multi-asset class investing, and broader macro issues like the Fed, inflation, and the massive influx of retail trading and investors. As always, thank you for listening. Please enjoy this discussion with Sierra Investment Management's Dave Wright. Dave, thank you very much for joining us today.
My pleasure.
We're going to talk about your approach to investing, which I would consider conservative, more tactical in nature. We're going to talk about how you manage risk and also manage money for the long term at Sierra. But before we get into a lot of those things, I wanted to ask you about your background, because one of the unique things I think with your background is that you actually were a lawyer, or that's what you went to graduate school for law, before you transitioned to asset management. So I just thought maybe to start, if you could kind of talk about how that transition happened, and then maybe as a follow-up, I'll just sort of ask within this question though, but is there anything that you sort of learned as a lawyer that you thought sort of helped in investment management?
Not so much as a lawyer. My initial degree is as an engineer. And that has helped very much because when you think about what engineers do, whether you're designing and building a bridge or a dam or a tall building, you know what point B is going to be. So you focus on point B, and every decision you make in the design and in the implementation has to serve that end, has to move you toward that end. So although my partner, Ken Sleeper, has a PhD and an MBA, you find that the mathematics we use for our tactical disciplines is really very applied math, if you will, very much more as an engineer would think. So every decision we make has to serve either the end of reducing risk, reducing drawdown in a diversified account, or improving return. Now, as a corporate lawyer, of course, I learned to deal with the SEC. These are different statutes that we operate under, but I do understand how the SEC works. And so we're able to understand compliance more thoroughly than many firms. And of course, we're committed to absolute conformity with the rules and regulations. And occasionally we get a chance to comment on them. So that really would be the applicability of my legal work for 13 years. But my engineering background was very pragmatic, and that's the way we manage money.
I did see that also in your background with the engineering undergrad degree, but I was kind of thinking there's another very, very successful investor with a law degree from Southern California. So I thought maybe, and that's Charlie Munger, of course, but I thought maybe there was something there with like law and investing, but there's certainly a lot more engineers, I think, in the investment management space, and those points are well taken. Let's talk a little bit about conservative investing at a high level to begin with. So I think a lot of people define conservative very differently in the investing space. So how would you define conservative investing in the context of what you guys do at Sierra?
All right, well, let's see if this resonates with your audience. We believe that it's the responsibility of investment professionals to understand technical aspects such as standard deviation, correlation, Sharpe ratio, Sortino ratio, and a number of other sophisticated metrics, if I can put it that way. But the way the individual investor feels risk is when their account declines. And in the industry, we call that drawdown. And so everything we did starting in the mid-1980s in developing our disciplines has been focused on limiting drawdown in a diversified account. We have a specific design parameter, again, as an engineer, I wanted to know what point B was in this regard of risk mitigation. And so in our diversified strategies and several of our other strategies, the design parameter is to limit drawdown to 5% per calendar quarter, 5% per calendar quarter after fees. And for 28 consecutive, 104 consecutive quarters, we have met that design parameter. There's only one quarter where very slightly we exceeded 5% drawdown, even in a very bad market environment. So this discipline and this focus, this specific goal, if you will, and the disciplines that we developed to serve that goal have been extremely effective. And I can give you a couple examples if you have time.
Yes, please.
All right. We opened our doors on October 1, 1987, and a crash occurred less than 3 weeks later when the Dow fell 23% in a single day, the crash of 1987. We use a trailing stop under every holding as our key risk mitigation discipline, and every domestic equity mutual fund and international equity mutual fund that we held in client accounts hit their stops on October 8th and 9th. So we were 100% out of domestic and foreign equities when the crash came on the 19th. Then, even more important, when the stock market peaked in early 2000 and fell 50% in the S&P gradually and in a bumpy ride for 32 months. That bear market was 32 months long into March of 2003. Our clients didn't lose a penny. They actually gained a penny after fees, a very small amount after fees. But in that entire 32-month period, our stop loss discipline was extremely effective. And then you flash forward to an even faster, steeper, and deeper decline from October of 2007 into March 9th of 09. You had the S&P drop 56%, which I think is the deepest decline since the 30s. I'm not sure at the moment. But it occurred in only 18 months, so a lot sharper and deeper. And yes, our diversified accounts declined in total almost 10%, a little short of 10%. But we met our goal of not having any calendar quarter decline more than 5%. But here's the key. Our buy discipline, which is sort of the reverse of our trailing stops on the sell discipline, had us back in very aggressive asset classes within 10 business days of the March 9th, 09 bottom. And so we were about 75% invested in things like bank sector stocks, natural resources stocks, physical commodities, emerging market equities, emerging market debt, and junk bonds. And our clients were in new profit 5 weeks after that bottom. So that is really the flip side of risk mitigation, is taking advantage of favorable market environments using a discipline. So that for us was a very gratifying that, again, after 35 years and having back tested on 20 years prior to that, that our disciplines remained very, very effective in limiting drawdown. And drawdown is how the household feels risk.
Yeah. And I think that, what's the phrase, like everybody looks good in a bull market, but in a bear market, that's when you really find out like who has a good investment strategy, something like that. But we also know that in bear markets, investors tend to make really bad decisions in terms of selling at the bottom and being out of the market and then not getting in quickly enough. I mean, that's very interesting that your system was able to sidestep, all of the worst case in all those bear markets, but then be back in very quickly, because that can be, to some extent, that can be a challenge with some timing or trend following.
Yes, professionals are very aware of a cycle of emotion. There's some cool graphs of it, like a sine wave with emotional remarks all the way down and all the way back up. And you're absolutely right. Most money managers do not have a discipline for dealing with steep declines or sustained declines. And so you need a manager that can play defense as well as offense. That's the best I can do with a sports metaphor. But I love the metaphor about when the tide goes out, you can see who's swimming naked, right? Hope that'll screen for you. In any event, you do find out who does not have a sell discipline, and that kind of thing destroyed Merrill Lynch, destroyed Bear Stearns, destroyed Shearson, because they didn't think this way. And these are super sophisticated investors who spend tens of millions a year on analysts and market research, and it was totally inadequate because they never learned to play defense.
Before we get into some of the details around your strategy, just to go back to those early days in 1987, what was the core genesis of focusing on conservative investment strategies? Like, how did you land there? Did you do tests and say, how do we create a strategy that can withstand the test of time? How did you and your partner land on a conservative investment approach versus let's buy stocks and, try to get the best return for the long run?
Yes. When we opened our doors, of course, the technology was fairly primitive, and we did hundreds of seminars in LA County and Orange County. And in those seminars, most of the time, I would take a show of hands poll from the audience to find out more about their risk tolerance and also their return objectives. I also developed a 22-hour curriculum that I called Successful Investment Strategy and taught it for 11 quarters at Beverly Hills Adult School, where I, of course, had a two-way discussion with many local people, including some pretty sophisticated private investors and indeed some market professionals. And so that gave us a lot of insight as to the risk tolerance of the typical mid-affluent household. The other thing is that my partner and I believe that about 60% of financial assets held by households, individual investors, is held by retirees. And so we decided that that was an appropriate market for those reasons and a couple other reasons for us to address. So knowing that, we knew that one of our goals should be to limit drawdown so that we would have good retention, excuse me, um, happy results from our clients, and they would put more of their money with us and indeed refer friends and family members who ended up with some life event like a divorce or the sale of a property or an inheritance. So that has really been the focus of our investor population, people who are inherently conservative and who really don't like declines at all. They find declines much more important than having an advisor who hits triples on occasion.
That's one thing that is very important for retirees is managing that sequence risk, especially early on in someone's retirement. I mean, someone retires and they're 8% in stocks, and then you go into a 2007, 2008, early 09 market, they're going to absolutely get crushed, especially if they're drawing off of the portfolio. So I think what you're talking about is very important for the vast majority of investors.
Yeah, exactly right. The large majority of our direct clients are in the withdrawal phase of their lives. And you're absolutely right. Imagine during the 32 months of the first big decline, cyclical bear market of this century, for 32 months, you're taking money out and your account is getting smaller because of market decline, down 50% in the S&P, depending how much of your portfolio was in equities. And at the same time, you're taking money out. So those people never recovered. If you retired before 2000 and you went through that episode, your net worth never recovered. Your financial assets in accounts never recovered back to where they were in 2000. So yes, sequence of risk is extremely important to our clientele. and to most households as they approach retirement or are in retirement.
And by the way, that's an excellent point because, we can't look at the bear market of early 2020 and think that that's a normal bear market, 30 days, 35% down in 30 days, but then it basically bottomed, within a month and then you're off to the races again. So, most bear markets are a lot longer. So investors should realize that. And I think a lot of them do, but that's an important point that you're bringing up.
Yeah, that was too short of a decline for people to get really scared or panicked at the bottom. And public investors and some institutions panic in the final weeks, and that's what creates the washout and gives room for the sustained rally and the renewal of a bull market. So again, there are various emotional aspects that are connected with a market decline. And halfway down, people begin to lose their complacency, if I can put it that way. We now have record complacency after a record long period without any multi-quarter declines. So I personally define a bear market as having multi-quarter declines. And 2020, of course, wasn't that. But when you have market declines for more than a few months and more than a couple of quarters, it really changes attitude out there and it begins to feed on itself. So if you have overvaluation to begin with, not at all a good timing tool, valuation turns out to be a fairly reliable and accurate metric of how deep the bear market will go. And of course, we're in high overvaluation now, and the next bear market could be pretty deep.
One of the things that I do worry about a little bit with the market today are more there's obviously millions and millions of new investors that have come online that are investing, younger investors that hadn't seen what a true bear market is. And so I worry that and listen, as a new investor, you're never going to see a bear market until you go through it. It's just, the only market they've seen is basically straight up. And so that's just not the reality of long-term investing. I worry that that when the real bear market comes, that some of these investors aren't going to be mentally prepared for it. But I mean, maybe that's another discussion for another day. It's just one of the things that I sort of think about when I think about these millions of new investors that have been investing.
Yes, we think about it also. Those people aren't really our client because they're not conservative, and also because very few of them meet our minimum for new client relationship. But yeah, there are people speculating in futures, options, cryptocurrencies, and a lot of accounts where they're really not getting advice. Robinhood and things like that. So the marketplace has generated new opportunities to take on risk. And virtually nobody under 30 really understands how deep declines can be and how scary they can be. And there are a number of rationalizations on the way down. Well, I should buy more. I should buy the dip. That happens for a while. And okay, well, this looks like it's over because bear markets are characterized by really impressive bounces, short-term rallies. And so it's very hard for the individual investor to understand which rallies are the beginning of a really good long-term uptrend and which are essentially going to be brief and fail. And then you get to the point where you're saying, well, it's too late to sell. I'm down 30% or I'm down 40%. And then they ride it further down. And then finally, there's the capitulation phase where a great number of investors see a really bad down day, like 6% in one day in the Dow, and they throw in their hands. And that markets always overshoot. They overshoot to the upside every cycle. They overshoot to the downside. And in other words, they go below fair valuation, and that sets up a buying opportunity for professional investors and institutions around the world to buy from what's called weak hands. So that's how market bottoms are created. But on the way down It's pretty complicated, and individual investors under 30 or otherwise unsophisticated aren't ready for what's coming.
I wanted to ask you about building a conservative investment strategy in what is effectively a low yield environment and how you think about that. I think the 10 years at like maybe 1.4, 1.5 today. So yields are at historic lows. So I mean, how do you guys think about building conservative investment strategies when you have yields as low as they are today?
Yes, really good question. We believe that it's not helpful to focus on yield at all. We believe that the best approach is to focus on what's called total return, the combination of yield from the asset types that give you yield and appreciation at the same time. So the combination of those two is called total return. So, for example, if we have a retired household that needs 15,000 a month, we simply instruct our operations staff which of their holdings should be trimmed. That group, for each member of that group, which holdings should be trimmed, and our operations staff knows exactly how much each family needs, and then we wire that money directly into their checking account. So what we want to do is what I call the best we can to get good returns in every part of the cycle, but at the same time monitor every holding daily with our trailing stop discipline to keep them out of trouble. So yield for us is not an objective per se. It drives some financial advisors nuts because they're trying to create portfolio flows from interest and dividends to match each individual client. That's not only time consuming and a waste of time, in our opinion, but it is massively difficult in a period like this where we have among the lowest yields for 30 years. People that we used to call savers, who 30 years ago would simply roll over CDs and be very, very safe, and they didn't know or want to know anything about the stock market. Those people have zero chance of meeting their retirement objectives rolling over CDs now, of course. My bank is paying me 1/10 of 1% a month, I'm sorry, annualized now in my savings account. So, and of course, this has had major impact on households who have been pushed by this Fed policy to invest in risky assets. And that was part of their objective after 2009. But it is, in my opinion, a problem and inappropriate.
Are there any opportunities that you're looking at that you think are undiscovered or are areas that investors maybe wouldn't expect?
Well, for our house accounts, for our direct client accounts, the first thing I look at is municipal bond mutual funds, and Nuveen High Yield Municipal Fund is our largest holding in that area. They're very, very skillful managers of municipal bonds. Municipal bonds tend to be in the aggregate, in other words, in a mutual fund portfolio of hundreds of bonds, they tend to be very stable in value, and you're getting the yield, which is tax-free, free of federal income tax. And we also, for our California clients, invest in mutual funds that specialize in California bonds. Now, the muni bond mutual funds do decline occasionally more than, let's say, 2.5%. If you were doing this at home, maybe every Friday, look at the value of the mutual fund, the muni bond mutual fund, and if it's down 2.5% off its high, sell it temporarily and move into a tax-free money market account or money market fund. And then when it rises 2.5% from the bottom, buy back into it. This is a very simplistic approach, and it will work. It will keep you out of trouble. You'll never have a drawdown in that category that bothers you. Another category is high yield corporate bonds. They tend to be very stable in their uptrends and fairly stable in their downtrends. Again, a 2.5% stop will work on a high yield bond mutual fund. Some of those are exceedingly well managed, including Fidelity and Blackstone, for example. You want to look for mutual funds where the investor share class, the public share class, has a relatively low expense ratio. We buy institutional shares, which have low expense ratios. But even the public can benefit substantially by having money in high yield corporate bond funds most of the time. They will decline when the stock market declines because they are tied to the health of corporations. And so you do want to have stops under them. And then when things get better, they will rise, they will recover in value, as well as paying among the highest dividend yield in both directions. So that's the second asset class that most public investors don't really focus on, but buy funds and not individual bonds.
Yeah, both good areas for, I think, for people to explore that are looking for something lower risk. One of the topics or things that obviously investors are thinking about is you have very high stock market valuation based on almost all measures, maybe not relative to interest rates, but any market multiple, whether and if it, Tobin's Q, the Buffett indicator, stock market to GDP. I mean, everything looks sort of pinged in the red zone. And then you have, ultra low yields. And so the question is, what does that bode for the 60/40 standard stock bond portfolio going forward? I mean, most people are thinking it's going to be lower stock market returns, and then you have rates where they are. So how do you think investors should look at the future of the 60/40?
Yeah, again, a stop under that holding would be a good idea. Generally, I suggest in the current environment, which I believe is very high risk going into January, very high risk. January has a surprising history of seeing the start of sustained market declines. So have a stop under your largest 5 holdings. Have a stop under your riskiest holdings. For example, equity mutual funds. On the 60/40, they will be milder, but they can decline 15, 20% over time. And most public investors don't feel comfortable at all having a decline of 15% that's sort of slow over 6, 8 months. So you can avoid that if that's one of your larger holdings, more conservative than a pure equity mutual fund or ETF. Um, and I would say put a stop of 6% under a 60/40 fund, and that'll keep you out of trouble. If the market continues up, you're a genius because you didn't get worried enough to sell based on overvaluation or anything else. If the market goes down, you're a genius because you don't get back more than 6% off of last week's high.
You could be a genius in both directions. I like it. um, Inflation is obviously front and center right now in the market. I mean, we're seeing some of the highest inflation we've seen maybe in the last 30 or 40 years. I know you're not an economist, but obviously you've been in the markets for a very long time and you've seen periods of high inflation. Obviously, the last 10 years, up until about a year and a half ago, we were in a period of, low inflation. But do you have any sort of opinion on whether or not you think this inflation is going to be more persistent, or is it going to be more transitory in nature?
This inflation will last longer than will be comfortable. As you said, I'm not an economist, but I've seen a number of cycles, and we get the data flow as part of the information flow that we see every day. A lot of it is a mix of market information and economic information. But yes, this inflation is problematic. It is a separate risk factor and a very large risk factor for the equity market. There are a range of opinions about whether the Fed has been wise or unwise And I tend to have more faith in those knowledgeable economists and others who believe this is unwise. I believe the Fed is way behind in this cycle, should be tightening. At the very least, they should be increasing the margin requirement for the amount that the margin interest rate. So they should be tightening that as they did in prior cycles. But apparently, the current Fed governors have forgotten that mechanism. There are other mechanisms they could tighten gradually. It's not all about their selling or buying less of bonds. So I believe that we've set up for a very dangerous year ahead.
Do you see any value in, and this relates back to inflation just for a moment, but any value in things like gold or commodities in portfolios during periods of high inflation?
Yes, we do own positions in commodity funds, probably no more than 6 or 7% in a globally diversified portfolio. I believe that in an inflationary period like this, there's likely to be a sustained rise in a basket of commodities. There are mutual funds that track an index of many commodities. So there are 3 or 4 of those that you can find. So I think that should be a piece of your portfolio. Here's my reply as to gold. Gold is extremely volatile, and it isn't always a hedge against inflation. The best hedge against inflation is real estate. There are mutual funds that invest in REITs, real estate investment trusts. We prefer those that invest in preferred stock of REITs, and there are 4 or 5 of those funds. So if you want to have something that's a really good hedge against inflation, put it in a box and don't look at it. I would suggest real estate mutual funds as being the best hedge. With gold, here's what I say. It's a very, very volatile commodity in price. It is not a perfect hedge against inflation. And there are times when you're going to be really scared after a significant 30-40% decline in gold. So are you going to own enough gold as a proportion of your count to make a difference? If you do, you're owning enough to be really worried when it goes down 40%. So we avoid gold or silver, and we would prefer to be invested in a diversified commodity fund.
We run some strategies that incorporate a trend following overlay on equity portfolios. But in doing some research for this podcast with you, I saw that you actually use a trend following system on junk bonds. So can you just talk about how you actually do that in that investment strategy and fund?
Yes, sure. Yeah, we use in effect a trend following strategy on everything. That's a consequence of having a stop under every holding that we monitor every single day. And the degree, the magnitude of the stop, in other words, the bands that we tolerate for each asset class are different and dependent on the historic volatility of the asset class. As I mentioned before, with muni bond mutual funds or ETFs, or high yield corporate bond funds or ETFs, a 2.5% fixed stop is a simplistic way to stay out of trouble, and also a simplistic way to get back in with some assurance. A third of the time, the market's going to reverse and you'll find you're wrong, but you're not on the wrong side of the market very long or for very much of a move. And then conversely, some of the trends will last a year or more, and that's wonderful. But this is a great discipline for trend following, and we use that discipline for all asset classes. If you're trading the S&P, you want to have perhaps a 6.5% stop that you can check once a week or whenever the market makes you nervous. That's a stop off the high close in the S&P. And then you want about an 8% stop for getting back in. So the The consequence of using a stop discipline like this is that, in effect, you're saying, I want to participate in the majority of any sustained rising trend. So it's trend following. You move your stop up every week. That's what we mean by following. And then in a declining market, similarly, you're going to stay out of the market until it makes um, a rise of several days or a couple of weeks and meets your criterion for the buy stop. So it's trend following in both directions. Stay out when the trend is down, be in any sustained uptrend, and take the emotion out of it.
Yeah, I guess you're right. When you're using stops, it's automatically, in like your example, it's automatically like it's implicitly like a trend following approach. I was kind of thinking like sometimes with an equity portfolio, you may be in or out of stocks on the whole, but you may run individual stops on the positions within the portfolio.
Yeah. We don't look within the portfolios at all. So just for clarity, we only use mutual funds in our private accounts. And we also look at ETFs for our own mutual funds, which emulate four of our private account strategies.
If you were to explain the risks of that to an investor, like where maybe a stop loss implementation or trend following could go wrong, what would you say?
Good question. With mutual funds, they're only priced once a day. And so if there is what we used to call a flash crash, and there really haven't been any of those for a while, where something weird happens on the New York Stock Exchange or NASDAQ and stocks plummet very briefly, that would take you through a stop loss that you have posted in the market for an ETF or for individual stocks. But it does not affect the pricing of mutual funds because all the flash crashes resolve before the close that day, or the exchange cancels trades on a couple of those days. So that's another reason to use mutual funds rather than ETFs. There are about 8 factors on both sides. There are pros and cons of using ETFs versus mutual funds. It's kind of a complicated trade-off, but we do like ETFs at certain times and for certain asset classes. So we're not 100% out of them, but we think there's extra risk in equity ETFs that you don't want to have overshoots where they blast right through your stop.
Would there ever be, I'm just wondering from like a tax standpoint, would there ever be a situation where you've held an asset for a long time or a fund for a long time, you're almost to the long-term capital gains mark, but then, something goes wrong and it drops below the stop? Would you ever override or no?
No, we don't override. However, on those occasions, historically, we have sometimes hedged 100%. So in some asset classes, there's the ability to hedge. That's true of high yield corporate bonds. It's certainly true of treasury bonds and other high grade bonds. It's true of the stock market. It's not true of a mutual fund that invests in European small cap stocks or that invests in emerging market debt. At least we have never attempted to find hedges for the more exotic asset classes. We just sell them.
That makes sense. Before we wrap it up, I wanted to ask you about the Sierra Tactical all asset strategy. And I wanted just to kind of get maybe some details around building and constructing and managing an all asset sort of multi-asset type portfolio. So maybe to start, what are the major asset classes that you consider for the portfolio?
Yeah, in our unconstrained portfolio, which is reflected in our tactical all asset mutual fund, we can invest in any mutual fund in the country. In other words, any asset class and funds within any Morningstar category, which now, of course, go far beyond individual asset classes. Some are multi-manager and a number are multi-asset class, and some of them are tactical. So we can invest in any mutual fund in the country and any ETF in the country. On occasion, we've had small positions in Malaysian stocks or Singapore stocks um, in that mutual fund. So we are completely unconstrained. We typically don't go above 70% equities of various kinds. We like equity surrogates like high yield bonds and preferred stocks and master limited partnership mutual funds that are highly correlated with the stock market but less volatile. We don't have specific requirements for maximum and minimum exposure in any asset class. I hope that answers the question.
Is the buy criteria mostly momentum based?
You could call it that. We don't buy things, we don't choose things based on momentum. But in effect, we need a rising trend to hit our buy stops, if you will, the reverse of a sell stop. So we're looking for an upward trend, which you could call momentum. But if we have a lot of green lights flashing on at the same time, it's very rare for us to pick the one or those that are the highest, the steepest rise, which is the definition of momentum. We will have a variety of actual purchases when that opportunity comes. We want holdings that aren't internally highly correlated with each other.
Just in closing here, we always like to ask our guests this question, and I'm really looking forward to hearing what you're going to say. But is if you could impart one piece of wisdom or teach one lesson to your average investor, given your experience in the markets, what would that be?
Yeah, I think this is the highest risk period that I've seen in the last 12 and a half years. And at some point, there will be a major cyclical decline, which will have some very steep parts to it. So this is a time when people should understand stops and apply reasonable stops to each of their 5 largest holdings, if not more. 5, I think anybody can do. Check them once a week, or if the market begins a steep downtrend, be very disciplined about implementing those stops and don't rationalize things the way a lot of people do. So make at least that part of it very defensive. If somebody throws a softball at your head, what do? You duck. And so think about the market that way, because it will be throwing some softballs or worse at you, I believe, in the coming year.
That's great, Dave. Thank you very much. If people want to learn more about your firm, the investment strategies, read some of your research, where can they go?
Yeah, they can definitely access a lot of detail about our strategies. I intentionally put more detail into our prospectuses than almost any other fund.
Okay, thank you so much. I really appreciate it. This has been a good discussion.
It's enjoyable for me also. Thank you.
Thank you very much, Dave. Happy holidays.
You too.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.